All right, what's next for this incredibly ridiculous volatile market that's driving everybody crazy? When Wall Street gets emotional, you know what we do? We need to try as hard as we can to put our emotions to the side, make some logical decisions. That's why I like to fall back on the technicals in times of turmoil, because they give us a more quantitative, more empirical, less emotional approach. So tonight we're going off the charts with the help of Carolyn Barodin. She's that brilliant technician who runs the FibonacciQueen.com website. Also, obviously, my colleague at RealMoney.com, where I blog, to get her read on this topsy-turvy market. Now, the last time we spoke to Barodin, early February, she warned us that the S&P 500 might be vulnerable to a major correction. She told us that we could have a bit more upside, maybe 2 or 3 percentage points, but after that, she expected turmoil, and turmoil is exactly what we got. I bring this up because Barodin also told us to watch this one very specific thing. Now, take a look at this daily chart of the S&P, okay, 500. Now, you see the blue is the 5-day, the red is the 13-day. See the blue and the red lines? The blue line is the 5-day exponential moving average. The red line is the 13-day exponential moving average. Barodin's always looking for crossovers here. When the 5-day goes above the 13-day, she likes to use that as a buy trigger, if it means you've got momentum on your side. When the 5-day goes below the 13-day, the momentum's against you, and it often is a signal you should sell. Does the trigger always work? Of course not. But she says it's helpful a pretty high percentage of the time, and when it's right, it is really right. So on Monday of last week, the 5-day crossed below the 13-day. And if you were watching these exponential moving averages like we told you to, you should have gotten out. Right there, just like she said. You wouldn't have sidestepped the whole correction if you sold on Tuesday morning, but you could avoid a lot of pain. The S&P is down about 7% since then. You want to miss those kinds of pain, even after yesterday's huge bounce. Oh, and we're down nearly 9% since she told us to be aware of a big sell-off a month ago. So the reason I go to her is that, she's predicted we would have this rally, and then she predicted we'd have this sell-off. I think that's pretty fabulous work. In other words, she nailed it. So what does she see happening next? All right, now check out the daily chart of the S&P with all of Barodin's Fibonacci goodness. As the market was getting hammered last week, Barodin wanted to know when the decline would end. This is where her Fibonacci methodology comes into play. She measures the scale and the duration of past swings in a given security. Then she runs them through the filter of Fibonacci ratios. That's a key series of numbers discovered by the medieval godfather of math, Leonardo Fibonacci. And that gives her a set of levels and dates where a trend is likely to reverse itself. It's the dates we're concerned with right now. Barodin started calling for a bounce on Friday because of these Fibonacci time cycles. And sure enough, the market started showing signs of life on Friday afternoon before exploding higher yesterday. Although we've now repealed a decent chunk of that, of the game we just had. So what's next? If yesterday's lows hold, can the S&P resume its long-term uptrend? Barodin says it's a possibility. And if that really was the bottom, then the S&P could eventually work its way all the way back to 3,539. However, she says there's one scenario. She also thinks you need to be on alert to the very real possibility of continued breakdown. As we saw today, the Fed's pushing on a string with a double rate cut. You can't cure the coronavirus with lower interest rates. As long as this outbreak keeps spreading, it's going to weigh on the market because the economic impact could be severe. So Barodin's not convinced that the averages have bottomed here. Remember, the 5-day exponential moving average is still below the 13-day, which tells her it's time to sell. Plus, the S&P is now well below its 50-day simple moving average, and we're falling through every meaningful floor support that we had. If we end up retesting Friday's lows, Barodin's not sure they will hold. So we have a mixed. It's one of those. I typically don't like this kind of situation. I like them when they're clear. On the other hand, if that low does hold, then the upside could be enormous. But if you want to make a bet, Barodin says you need to be ready to bail if the trade starts going against you. So what you'll see from that is if it does go through, there'll be a lot of people who suddenly just sell, okay? So there's going to be a whoosh down if that level doesn't hold. All right, well, let's put this in context. I want you to take a look at the daily chart of the largest company on earth, Apple. Now, when Apple put on a bottom on Friday, you had a cluster of Fibonacci relationships pointing out that a pivotal low might be in the works. Barodin's methodology predicted that there would be a powerful floor support around $256. Well, where did Apple bottom? $256. You also had a bunch of timing cycles pointing to the possibility of a rebound on Thursday or Friday. Well, sure enough, yesterday Apple exploded higher, and while it gave back some of those gains, it's still up more than $30 from its lows just a few days ago. Now, Apple has a ceiling of resistance at 312, but if it can clear that hurdle, she sees it going to 347. Of course, if the floor doesn't hold or if it fails to clear that ceiling, well, you're looking at a much more bearish story. Bottom line, the charts as interpreted by Carolyn Baroden suggest that some stocks might be safer to pick at here, like Apple, but that the broader S&P 500 might not be out of the woods yet. As we saw today, yesterday's huge bounce could prove to be a tad ephemeral. Xander in Washington. Xander.
Booyah, Jim.
Booyah.
I'm looking to add AMD to my portfolio. With today's big spike and sell-off, would you recommend hopping on the AMD train sometime this week?
I am, at this very moment, a little more conservative. I happen to like AMD, so you can say, well, Jim, what are you backing away from AMD? I'm backing away from a lot of stocks that have economic cyclicality. Even a company as fine as AMD might have some, and I just think you're going to get it at lower levels. I'm not saying it's a bad company. I like it. I'm not telling you to sell it. I'm just saying if you had a new position you wanted to start, I don't know whether this is the time, because the cyclical stocks are doing terribly, but AMD is a real good company. Now, in a volatile tape, it's important to put emotions to the side. The chart suggests that there's some stocks that could be safe to pick at, like Apple, but the broader S&P, not out of the woods. Much more Mad Money in. It's been tough to navigate the market's recent turmoil, but could it yield a buying opportunity in a really cool company called Livongo that has no economic cyclicality? I've got the exclusive after the earnings. Then, between $100 million in rate cut, I choose the money. I'll explain why. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.